It's time for the Your Personal Bank Show with Ferenc Toth, president and founder of Secure Estate Management. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Welcome to Your Personal Bank Show. And I know for a Thursday crowd, we're kind of new for you guys. And it's really cool that the Money Radio wanted us to be on this additional time. We've been on for about a year now on the at noon on Tuesday. So if you are a Tuesday listener, then welcome again. And for those of you who are not as familiar with the personal bank concept and what we've been sharing for this past year, I'm going to really encourage you to go to yourpersonalbank.com. That's our website. We have all the previous shows recorded. You can listen to them there. You don't have to listen to the advertisements. The advertisers won't like me saying that, but okay. But obviously, and it's got topics on each of the shows. So if you want to listen to any of the topics of what we're talking about, we talk about a lot of great stuff. Some of our most popular shows, a couple of guests I've had recently that were awesome. Our April 28th show, we had John Burley, one of the top real estate experts in the country and a real estate investor himself. Okay. And on mid-May, I think it was May 14th or 16th, we had on Brandon Miller. He's the director of lending with M&M Bank, talking about one of these banks that we work with in terms of doing the line of credits. Okay. So it's against the policies. What is your personal bank concept? It's really quite simple. I can tell you in one sentence, and people get it. It's really all we're doing is we're taking a bank tool, a bank line of credit, with an insurance tool, a high cash value policy, and we're strategically integrating the two tools to grow your money, tax favored, and then when you access it, again, no tax consequence, and then you get positive arbitrage on the money, even after you spend it. That's what separates this from everything else out there, basically. See, when it comes to financial investments, most investments, obviously, rate of return is important. ROI is important. Absolutely. It is here too. But when you access the funds, you can grow your money. That's great. But what about when it comes to distribution time? What about when you need to access the funds? And that could be for retirement. That could be for purchasing things. It could be for business purposes. It could be paying off debt. It could be any number of reasons why you have a need or access to the money. And the challenge that just about every retiree deals with, and the biggest fear of retirees, this is no secret, is, will I run out of money in retirement? Will I have enough? And, a lot of people, it's hard to tell. There's really no way to ensure that. The key is add guarantees and increase your income and make sure your money lasts longer, right? What do you do to make your money last longer? When you take it out of any investment account that exists out there, it's gone. Once you spend it, it's gone. Its ability to grow for you in the future disappears. Okay, so again, that's the dilemma. When do I start taking money out, for example, to supplement retirement? How much do I take out? Will I have enough to last? And yes, there's Monte Carlo simulations and there's all types of things out there to help kind of determine that. But unless you've got just a whole heck of a lot more than you know you're going to need, that's a concern for a lot of retirees out there. Okay, what does your personal bank do? Well, one, on the insurance side, and please, forget what you need to forget what you understand about insurance. Most people think of it as a death benefit protection tool. You pay the minimum premium to get the maximum death benefit. And there's nothing wrong with that. I mean, we still have folks that do that. I have some of that myself. And from a death protection standpoint, by all means, take care of those needs. But what I'm talking about is this very specific type of contract. It's a high cash value tool designed to grow cash on a tax-favored basis and minimize the death benefit. So again, everything you understand about insurance, flip it on its ear. It's completely the opposite. I use the example of a teeter-totter. And if you can picture in your mind for a second a teeter-totter where you put the cash value on one side, death benefit on the other, okay? Again, the vast majority, I'm talking well over 95% of policies that exist out there are designed, and frankly it's closer to 99%, are designed to maximize death benefit. They're a death benefit protection tool. Irregardless of what anybody's trying to tell you or an agent's telling you, there may be some cash there, but 99% of them we look at are really designed to maximize death benefit. There may be some cash, but again, the goal is the death benefit. Why? Well, for one, for a lot of people, they need death benefit protection. I have a family, I own a business, I have some of those needs. I have some of those tools in place to satisfy those needs, and as you should also if you have needs similar as I do. But when you're trying to grow cash, you're in a different ballgame. You're talking about a different product. You're talking about structuring it differently. And very few people, advisors, agents, insurance agents, or individuals are really familiar with this tool. It's starting to become a little bit more so. The insurance banking tool sometimes are known by a number of different names out there. But even then, the idea of bringing in the bank line of credit on top of it is foreign to most people. And when I've been sharing this, I'm going to tell you, this is kind of cool. Why did I bring this in? Why I was able to put these two together? And by the way, this is a process over several years of, try to get a bank and an insurance company to work together. That's a process. But anyway, my point is I'm an entrepreneur. Those of you that don't know, check my bio out on yourpersonalbank.com. I've actually owned 4 different companies. I've started, I owned a retail business, a contracting company, the financial agency the last 16 years. And past couple of years, I've been the chairman of the board of a bank in formation. We're in the process of starting an FDIC insured bank. Of course, COVID has put things on hold for now. But, so that's my 5th entrepreneurial endeavor in my career. So now I'm an entrepreneur at heart. Yes, I'm a financial person too, but that's at heart, I'm an entrepreneur, and I've got a lot of banking understanding, being on the board of a bank, being able to put the two together. And again, what does it do? I've got a chart. Be happy to share with you. If you contact me at yourpersonalbank.com, we can set up a 20, 30-minute chat or go to meeting, and I'll show you this chart. And this was put together with financial institutions. They asked me not to share this publicly, like on the radio or on my website. I'm honoring that request, but I can show it to you individually, and it'll show you the dividend payers for the last 25 years. All the top dividend-paying companies out there. There are companies that paid 6% or more every year for the last 25 years, folks, and still pay that today. There's 3 that still pay today. I'll show you who they are. By the way, some of those names, you're going to recognize a lot of the names. And by the way, all of those companies have paid dividends for the last 100 years without missing a beat. In other words, they paid dividends through the Great Depression. So if you're looking for a dividend payer or an interest payer, an income asset to supplement retirement or for whatever other reason you want to supplement income, you really should look into this. 6% is darn good today, tax favored. And then it gets better. We bring in the bank line of credit and we can get your rates as low as 3%. Okay? If you're money and you access the funds through the bank line of credit. Well, folks, it's simple. If it's not that complicated. If your money's growing, earning 6 and you're getting charged 3, what's your money doing? You see my point. What happens to your money over time? Well, you have more of it. Even though you spent it, the portion you spent is still growing at 3. Positive arbitrage. Okay? In other words, you're earning more than you get charged. So I like saying this, folks. Look, leave it there, make 6. Take it out, use it through the bank line, no tax consequence, and the money still is growing at 3. Positive arbitrage, net effect. That's really cool, okay? Which means you're going to have more money every year going forward, and there's guarantees involved with all this, fixed options, all kinds of things. Stay tuned. I'm going to get into more detail about how this works so you can see why it would make sense.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back to Your Personal Bank Show. And we've been talking a lot about the personal bank concept. Like I said, real fast, it's simple. Taking a bank tool with an insurance tool, strategically combining them to create positive arbitrage on your money, even after you spend it. We have long-term dividend-paying companies. I'll show you the chart of all the different companies out there that have been paying dividends for the last 25 years. This has been put together by a financial institution. They've asked me not to share this publicly, but I can individually. So contact me at yourpersonalbank.com. I'll show you. You'll immediately recognize who you want, if you're looking for dividend-paying, interest-paying, income earning type asset, you'll immediately know who you want to work with. A+ rated, been paying dividends for over 100 years in all cases. Okay. These are long-term dividend payers. Then we connect you with a line of credit. Depending on your situation, we can get as low as 3% today. Okay. On the line, the collateral for the line is the cash in the policy. So if you're getting credit 6 and you're getting charged 3 when you access it, what's your money doing? It's still growing, isn't it? You got a 3% positive arbitrage. By the way, there's no loan fees. You only get charged interest when you access the funds. Okay. Doesn't affect your debt to income ratio for other financing because the bank doesn't report it as debt. It's a collateralized line of credit. Okay. And like I said, one of the interviews I did with one of the bank lenders said, what are you waiting for? There's no fees. There's no costs. Even if you're not looking right now to access the funds, still set up the bank line just in case. Because if you access to money and not needing it is more important than suddenly find yourself needing it and not having access, right? So if you want looking for dividend, interest, earning kind of stuff, take a look at this. This is a really good tool. 6.1 with guarantees, tax favored is really, really strong with, again, 25-year history of paying that or more, over 100-year history of never missing dividends. That's really strong. And like I said, but again, the bigger part is, the other part is not only the growth side, not only the ROI, return on investment, but it's also the distribution side. What happens when you distribute or access the money? Again, in most cases, if you take out money out of any investment account, what happens to the dollars that you take out, the future growth on those dollars? There isn't any. Zero, nada, right? You spent it. It's gone. Here you can pick up positive arbitrage, 2-3%, depending on how much dollars we're talking about. Folks, what does an extra 2 or 3%, for example, do for your finances every year for the rest of your life? If we're talking 10 years, that could be 20-30% more money. 20 years, more than that. And that's not even talking about compounding, is it? You see what I'm saying? We can be talking out, we're looking at significant amounts of additional dollars in people's pockets, okay? Let me play the devil's advocate for a minute. So, a lot of people talk about, I'm talking about cash value policies, very specific type, to grow cash, all that kind of good stuff. Not your typical insurance policy to cover death benefit. There is one, but that's not the major focus here. But people, there's the insurance banking concept. Some have been introduced to it. Some look at it. Some, and here's the thing. The problem is without the bank line of credit, that second piece, and this is another level, folks. This is something that's not very, well, let's put it this way. I haven't found anybody else doing it. How's that? I'm not saying no one else out there is. I haven't found them yet. And I'm out on the radio. And before COVID, I was out speaking all over the Western U.S. I just spoke this week to an author who's written a book about financial stuff, who's over the moon excited after talking to me twice this week, and now wants to join our team because she goes, I've never heard of anybody bringing in the bank line of credit piece. That is incredible. That's brilliant. I spoke to this week also a professor of finance from a university in New York. I won't say which one yet because this isn't official. He's asked me, he says he's very interested. He's very impressed. We've had a couple of discussions. He goes, I've never heard anything like this. This is incredible. He's doing his due diligence. He's very excited. He's asking me if I would be willing to be a guest lecturer and maybe and he's thinking about being a client himself. Okay. That's the kind of responses I get. I did a workshop some years ago. This is a gentleman who has owned several businesses. He's a Mensa member, and so a very smart individual. And at first when we first talked, he was very skeptical. He had the arms crossed. You know what I'm talking about. And within about 20-30 minutes, he was literally jumping in his chair, excited. He said, "This is incredible. Where's this been my whole life?" I spoke to a gentleman 2 days ago who we met a couple of weeks ago through a referral, went over some of his numbers. I'm just sharing you some examples of situations I've run across both recently and even the last few years. It's amazing, the response. This is a gentleman, very, very successful real estate investor, and he does e-commerce and various things like that, and very successful individual. He has funded monies he knew about the cash value life aspect. He's been funding monies into these for the last decade. Okay. He's pretty young guy still, but he's been funding monies into these past decade. And then when I shared with him the whole piece of bringing in the bank line of credit and then reducing the interest and showing, basically here's what I did. I showed him how to get 1% more, giving him a better dividend paying company, and reducing 1% less on the bank side because he had already been doing some of that. So I added 2 points, 2%, on his returns, positive arbitrage. So he was getting 1 point positive arbitrage. I tripled it to 3 points. He sent me a text. I have it on my phone right now, a few days ago. He says, "Thank you for such a productive meeting." He's a new client. We did the application yesterday. Okay? This is the kind of responses that I get, and it's worth it to you. And I know we hear this stuff all the time. This will change your life. Well, this is actually one of those things that's truly a win-win-win. And I'll explain what I mean by it. But contact us at yourpersonalbank.com. Let's set up a 20, 30-minute online or phone meeting. Online's ideal because I can show you the chart that I'm talking about and various things. I can show you who all the top dividend payers are. You'll immediately recognize it. You'll immediately understand who you want to work with and why, where you want to put your money, all that kind of stuff. And these are names you've recognized, okay? My point is simple. We get bombarded by stuff, but here's the thing. This is truly one of those win-win-wins, and what I mean by this is simple. Obviously, if you can earn money and get a consistent, solid rate of return, and 6.6% plus today is I think anyone would agree, strong. Particularly when you add that kind of rate over the past 25 years. The last decade, since 08-09, we've had a historically low interest rate environment. So dividend payers, interest payer, income earning assets have become increasingly more difficult to find. So those that are wanting to supplement retirement, for example, it's become more and more challenging. Okay? We have a solution for that with tax benefits, with guarantees, okay, and with positive arbitrage. Okay? So my point is simple, is, we look at this, okay, and we can offer a solution that makes sense for so many different people, okay? Again, this isn't for everybody, okay? But so few have looked at it. It's amazing the responses I get when they do. And those are, like I said, those are just some of the story. Where's this been my whole life? Why doesn't everybody do this? That's another one I got a couple days ago. And the thing I have to answer is they just don't know. Look, I'm doing my part. Heck, I'm on the radio trying to share the information so that people can be aware and make the intelligent decisions, right? Get all the facts. I do workshops and webinars. I've been doing this for years. I'm doing my part to get the information out there. All I'm asking for you is take 20 or 30 minutes to look at it and see why it's a win-win-win. Clearly, if you're getting a consistent, steady return with some guarantees and tax benefits, that's going to benefit a lot of folks. So that can be a real win. And then you when you add on top of that, the ability to get the positive arbitrage, where you can pick up 2 or 3% on money that you spent, which basically really isn't available just about anywhere else or any other method, okay? That's just a flat out win, right? For you, the individual, the client, the customer, whatever. The insurance companies love it because you're funding policies. They're reinvesting money, making money, right? The banks love it because they get to charge interest on loans. Folks, this is a win-win-win. You don't find that real often in life. Stay tuned. I'm going to talk about this a little bit further and share with you some more reasons why you should take a look at that or who should look into this.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back. Hey, I got to say, last segment I started to say I was going to play devil's advocate, and I kind of got off track and went on a different tangent. Let's take devil's advocate here. Personal bank concept. Remember, what are we doing? We're funding a policy, maximizing cash growth, tax favor basis. We're accessing the funds from a bank line of credit. Okay. No taxable implications by doing it that way. In fact, the interest can be tax deduction if it's used for business purposes in most cases. Positive arbitrage. We have companies paying 6% plus, have so for the last 25 plus years, never missed dividends for over 100 years, A plus rated, all that good stuff. So you're getting 6 plus. You're getting charged 3 on the bank line, positive arbitrage of 3%. Pick up 2-3% positive arbitrage long term over the next decade or two, and watch, you'll have 20-30% more money without compounding, won't you? That's it, folks. It's pretty straightforward. And once people understand that, they're like, where do I sign? In most cases, okay? Not everybody, but a lot of cases. Here's the thing. Let's play devil's advocate. So people say, they always look at the insurance piece. Well, it takes a long time to accumulate and grow cash, okay? For a typical insurance policy, that's absolutely correct. We're not structuring these typically. We are adding, basically, we're funding 60 to 90% in the cash bucket day one and every year, which means, what does that do? We're increasing the cash dramatically right out the gate. 60 to 90% liquidity, access to your funds day one, depending on how we structure it in your situation. But that's pretty typical. Typical, a normal insurance contract, a cash value contract, in most cases I see, first year cash, 0. Second year cash, and sometimes through 2, 3, sometimes 4 years even, 0. 60 to 90% cash day one is a heck of a lot more than 0. Would you agree? So that immediately we are like night and day difference. Flip everything on the end. Like I said, think of the teeter-totter. We're flipping everything the opposite way of what you're thinking about. So that, we just kill that. So it just takes that right off the table. And then secondly, folks, here's the other problem. So a lot of times folks say, okay, I can grow my money. Most policies, dividend payers these days are in the 5 to 6, some are in the high 4s. Let's say high 4s to low 6s. That's the range, okay? Today, 2020. Historically, I can show you the charts. I'll show you the charts from the lenders. I mean, there's nobody analyzes these products more than the banks who are lending against them and using them as collateral. I mean, let's face it. If you were a lender, there's probably some hard money lenders listening to me. Or private lenders. Let's put it this way. If you're going to put your money out and borrow against an asset, you're going to analyze that asset, right? You're going to be pretty confident you can get your money back, right? That's what these banks are doing. So again, they're not willing to lend against any old policy out there or any old company out there, by the way. There's about a dozen, okay, that the lenders are willing to loan against. There's a few outliers, but pretty much all the banks are willing to lend to these roughly dozen companies. Why? Long-term history, ratings, cash, long-term, maximized cash growth, right? I would listen to the lenders. They've analyzed it more than anybody else out there. And that's where I got this chart from. So my point is, I can show you that. Contact me, yourpersonalbank.com. We can set up a 20, 30-minute chat or GoToMeeting. A GoToMeeting or online would be best because I can show you the chart. I can't show it on public. I can't put it on my website. They've asked me not to. They put 25 years of blood, sweat, and tears into this, putting all this together. A lot of time, money, and research, okay? I respect that. But I can't share it individually. You'll immediately know who you want to work with. That's the beauty of it. Anyway, the point is simple. Devil's advocate. Okay, so we talked about the cash. Long-term, it takes a long time to grow the cash. Well, when we structure them this way, it doesn't. We got 60 to 90% cash day one, okay? And then it grows from there. 100% liquidity is typically done within 3 to 7, 8 years, depending on the case, age, situation, okay? So we've pretty much taken that off the table. The other problem is with the insurance banking concept. The insurance banking concept works, okay? That's not the issue. What it is the tools that are used sometimes don't work so well. The folks are not using the best tools out there. And here's what I mean by that. If your cash dividend growth is not high enough, then when you borrow, there's an interest rate. If you borrow directly from the policy, which you can do, there's a loan interest rate. Now, today, I already stated, I can tell you, based on the charts I have from the financial institutions, the crediting rate, how much you're earning, how much dividend you're getting paid, depends in the high 4s to low 6s in 2020. Okay? The loan interest rate, so when you borrow money from these policies, depending on the company, is in the mid 3s to up to 8. So mid 3s to 8. This is in current 2020. Most companies are paying in the 5s right now. Like I said, I'm going to show you companies paying in the 6s and have every year the last 25 years. But most are paying around the 5s, and most loan rates right now are around 5. Okay, some, like I said, 3.5. A couple of them at 3.5. Most of them are 5. There's some that are in the 7, 8 range. Well, if you're growing your money at 5 and you're getting charged 5, what's happening when you access it from the policy? You're not losing anything, but you're not gaining either, are you? It's marking time. right? So it's free access to money. That's great. I mean, that's a rare thing out there. I always tell investors or entrepreneurs, try investing money and accessing it with no credit checks, no applications. Get the money in a day or two, and no cost, no interest cost. Because you're earning 5, you're getting charged 5. Frankly, it's a wash, isn't it? You're earning what you're getting charged, right? So that's good, but not great. Conversely, let's say you're getting paid 5, I know of companies right now, big name companies, I won't say it to pick on anybody, but they're paying 5 right now and they're charging 7. Well, that just doesn't work, because basically you're losing 2% every year while you're accessing your money, right? This is why the bank line of credit is so important, and we've negotiated and worked with the right banks to find the best rates. And these banks have been doing this for decades, so this isn't new either. There's a handful, literally, of banks that specialize in this, and this is what they do. Well, if you're earning 6 and you're getting charged 3 to access your money, what's your money doing now? See the difference? So as I point out to people all the time, look, you put it in there, leave it, you're going to get 6 plus. Based, tax deferred with guarantees, not bad, especially after COVID, right? And long-term history of paying 6 plus. I mean, over the last 25 years plus, right? If you access it, use it, well, you're still getting 3 points, 3% positive arbitrage, because you're earning 6, you're getting charged 3, right? And if you're using the money for business purposes, that can be, the interest can be tax deductible in most cases. So think about that a minute. It's not that the insurance tools or the insurance concept doesn't work. What it is the wrong tools are being used, or the most efficient tools. Also put that the best, most efficient tools for this concept are not being utilized. Okay. The last reason, devil's advocate, I shared this earlier, and that kind of goes with the first one, not cash growth. We talked about 60 to 90%. Day one, 100%. 3 days, I'm going to say 3 to 8 years is typical. But what I find is, sadly, and I think this is mostly due to not being aware, fully understanding the tools. There's a lot to this. In terms of understanding how to structure these things, I've spent years doing this and learning and teaching others. And it takes a while to really understand how to structure these things. It's not commonly taught. How it works is very simple for the client, but for the advisor, for the agent, the person that's putting this together, there's a lot behind the scenes. I actually work as a specialist for a number of different advisors who recommend me as their personal bank specialist for their clients, okay? The thing is, there's a lot of products and tools that are just not structured to maximize cash value, or could be much more efficient than they are. So too much of the money is going to death benefit and not enough to the cash side. So what ends up happening is the cash is not growing as nearly as efficient as it could. We compare these products all the time. I'm comparing products every week. And so far, we haven't found one we haven't been able to beat. So because of structuring it correctly or having the right tool. I'm not saying it doesn't exist out there, but we can do that. So if you have something like this, let's compare it. Contact us at yourpersonalbank.com. No cost, no obligation. I'll show you more cash. Stay tuned and I'll show you some more stuff.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back. We're talking about the Your Personal Bank concept, and as I always say, what is it? Combining two financial tools, one from the banking, one from the insurance industry. We're maximizing cash growth. This isn't the type of insurance contract most people are familiar with. Maximizing cash growth on a tax-favored basis. Then we access funds from a bank line of credit using the cash as collateral for the line. And what happens is we create positive arbitrage on your money when you access and use or spend it. That's the concept. Current rates, we got long-term dividend payers paying 6% plus, have so every year for the last 25 years, have never missed dividends for the last 100 plus years, including the Great Depression. So these are long-term dividend payers. Have A-plus rated, tons of strategically sound companies, many of them names you've heard of and are familiar with. And then we bring in the bank lines. We have the right connections with the banks in terms of who's got the best rates, okay? We'll connect you with those. You can earn 6. You can get charged 3 on your money when you access it. So if you leave it there, you'll grow at 6. Tax favored with guarantees. If you access it and use it, pay bills, buy stuff, invest in other stuff, still pick up 3 points, 3%. Why is that so important? Well, gosh, do you want an extra 3% return on your money? Do you want to earn 3% on money you spent? I mean, you want to reduce the interest costs on things you're borrowing. If you're financing something, you want to reduce the interest cost by 3%. We can do all those things. That's why the personal bank's so powerful and makes such a difference, because you add 2 or 3% return on monies. Think about this. What if you could earn 2 or 3% on the dollars you spend? That's a lot of money for a lot of folks. Think about all the things you spend money on, all the expenses. I mean, building wealth is not just about return on investment, ROI, growing your money. That's a big part, don't get me wrong, but that's not the only part. And I find, personally, a lot of folks I talk to focus sometimes almost to the exclusion of ROI, return on investment. That's all they look at. And questions I start asking is, well, what are the tax consequences? What about the distribution plan? What are you going to do when you access the funds? What's your plan there? What's going to happen? With most investments, as we all know, when you take money out and you spend it or use it, what's the return on those dollars? Nada. Zero. Nothing. You spent them, right? Here, why not pick up extra 2 or 3%? What if you picked up an extra 2 or 3% on 10 grand a year, 25 grand a year, 50 grand a year, 100 grand a year? Okay, I have businesses doing that and more. Okay, we utilize this ourselves personally. Well, gosh, extra 2 or 3% can add up, and that can add up over time, over the next decade or two or longer. Think about the impact. With compounding, the impact is huge. And like I said, these are just dollars you were spending anyway, right? These are dollars that were going out the door anyway, and they're gone. What if you captured a portion of it? And you can do that with the personal bank concept. Again, grow it at 6, access it at 3, pick up the difference. Okay? That's the concept. It's that simple. Last segment, and if you didn't listen to it, go to yourpersonalbank.com. You can listen to the last segment or any of the previous shows. I was playing devil's advocate. People, the negative statements about the insurance is, well, the cash takes a long time to grow. Well, in a traditional policy, that is true. Usually the cash value in the first year is 0, sometimes for the first 2, 3, 4 years even. How we structure ours, 60 to 90% cash, in most cases, available day one. Okay? 100% liquid of the funds, what you've contributed within years 3 to 8, let's say, typically in most cases. So we're talking about lots of liquidity, lots of cash growth, and tax favored. Okay? So we kind of take that off the table. All right? Returns. Highest dividend payers. I'll show you all the different companies. I got the charts from the financial institutions showing all the dividends that have been paid by the top dividend paying companies for the last 25 years. So we have companies that have been paying 6% plus for the last 25 years and longer. Over 100 years of history of dividend payings, A+ rated, tremendous cash reserves. So if you're looking for dividends, interest, income, this is worth looking at. What if you're looking to diversify? Well, why not diversify? Instead of just being in certain sectors, for example, like a lot of people do, why not diversify flat out and be outside of the universe of Wall Street? That isn't the only thing out there. I know I'm talking blasphemy. This is money radio. But you know what? The fact of the matter is there are other things out there that exist that grow money. There's things with guarantees, things with tax benefits, okay? And if you really truly want to diversify, you want to diversify outside of you don't want all your money in that universe. If all your money's in real estate, okay, you might be comfortable there, but you're not diversified, okay? If all your money's in the markets, irregardless of what sectors and whatever you're doing, you're not fully diversified because it's all in that universe. Or if you're all in cryptocurrencies or precious metals or whatever, I often run into people where basically all their money is in one place or one bucket or one universe, if you will. Diversification makes a lot of sense. And like I said, I'm agnostic when it comes to what you invest in. if you are doing something that works, I'm not your enemy. I'm actually your best advocate. If it works, keep doing it. But here's all I'm going to say to you. Instead of just continuing doing what you're doing, why not add 2-3 points to your returns, 2 or 3%? Why not add some tax benefits? Why not throw in a death benefit? I know we're not doing that for the main. A lot of times that's not the main purpose, but I find most people are underinsured. Why not have a death benefit for you, your business, your loved ones, whatever it may be? And we almost forgot. There's living benefits. These are benefits that basically take care of you have medical situations or long-term care needs. There are benefits built in for these tools at no additional cost. They're built in. Okay, so I always say, look, if you have those kind of medical needs, chronic illness, things like that, long-term care needs, there are funds available with these that's built in. If you need it, great, you got it. If you don't, well, you didn't pay for it. So you can see where, what can be better than that, right? So you can see where a lot of solutions occur or come up using this personal bank tool. Again, the primary purpose for most people that we're doing it with is to grow cash, is to have some guarantees in place, is to get some tax benefits, and get some positive arbitrage when we use our dollars for other purposes, okay? But remember, there's other things in place. It's other benefits, like the living benefits, the medical expenses, the chronic things, or like the death benefit, God forbid that comes about. I mean, we are in a pandemic, right? Now, I'm not here to talk the politics about it, but it does bring to light our mortality, right? It does exist. We're not going to be here forever, okay? So my point is we can address all those issues or a combination of those issues using the personal bank concept, using the insurance tool with the banking tool to create that positive arbitrage, to put more money in your pocket. And not only that, put more money in your pocket every single year. I have retirees that use this tool, putting in income and assets into this, accessing it, getting the positive arbitrage, and basically creating a 2 to 3% increase, cost of living increase on their monies. I mean, that kind of helps offset inflation now, doesn't it? So again, there's so many different tools. Stay tuned to Your Personal Bank Show. We're on every Tuesday at noon and Thursday at 15:10 a.m. or 105.3 FM, or contact us at yourpersonalbank.com for more information.
Listen next week at noon for more information on Your Personal Bank. Contact Ference at 866-515-6280 or online at yourpersonalbank.com.
This show is designed to provide accurate and authoritative information. The presenter and guests on this program do not engage in rendering legal, accounting, or tax advice. Expert advice from a professional involving your specific situation should be sought, if required. Permanent life insurance is a long-term investment. Products, optional features, and riders may have limitations, restrictions, and additional charges and may not be available in all states. Withdrawals beyond principal may be taxable income. Excessive and unpaid loans may cause the policy to lapse. If a policy lapses, unpaid loans are treated as distributions for tax purposes. Replacements may not be suitable for everyone. There may be penalties and surrender charges when replacing coverage. New products may include new surrender charges and contestability period. Policy guarantees are based upon the claims-paying ability of issuing insurance company and do not apply to the investment performance or assets in the underlying variable portfolios. The life insurance and annuity products in this presentation are not FDIC insured, may lose value, and are not bank guaranteed.